Hello and welcome to Policy Bazaar. I'm Arjun Bhagat. Now, you already have your investments in stocks, bonds, mutual funds in paperless form. Now it's the turn of insurance policies to go paperless. Late last year, Insurance Regulatory and Development Authority, the IRDA, finally launched the insurance repository system, which will allow you to hold your insurance policies in paperless form, that too at no extra cost. Now, to help us get more details of how our insurance policies can now go digital, we have with us Yashish Daya, CEO and founder of Policy Bazaar. Welcome to the show. Yashish, now tell us, how does this really work, this digital or digitization of our insurance policies?
You know how mutual funds work in a demat form?
Right.
It's exactly the same. So essentially what happens is there are certain repositories. There are 5 entities which have been given the license by the regulator, the IRDA, to hold consumer policies all the way till those policies' life term is over. Now what that implies is whether you have an existing policy or a new policy, you can inform your insurance company that you want to get the policy converted into an e-insurance policy. What that will do is your policy will become an e-policy. You will get an account which would have a 13-digit username and your password, which you can access anytime.
And you're saying it's already available for consumers?
It is available. Yes, it's available. In case, so you can approach your insurance company, or you can approach any of the appointed people, as they call it. These appointed people can be anybody. So, you know, for certain, someone like a Policy Bazaar might be an appointed person, or anybody could be an appointed person. You could be an appointed person, I could be an appointed person. These appointed persons are essentially responsible for creating online accounts. So as far as the consumer is concerned, he can approach any of these people and get an online account. There's no extra cost to the consumer. Not just are his policies going to be digital after that. As we were speaking in one of the episodes about lapsation, etc., the chances that things lapse because you don't have the documents or one doesn't remember where the policies are, they can now be taken care of. In the sense, once they are digital, you can change your contact details. You don't have to contact one insurance company. Just go to your repository and change your contact details, your address, anything. And all your policies that are part of the same account, those details will change in all of them. So it just makes it smoother. All the policies get held in one place. That makes it smoother. What's more important is you can appoint a lawyer or your chartered accountant or somebody to be the person who manages this for you. So in case the individual has a problem, which is when these policies really come in handy, in case of death, disability, critical illness, any of these situations, they may not be able to operate this repository. So these details exist with their chartered accountant and their lawyer. They can execute them, and they can kind of make the claims on their behalf. So all in all, it's about making the consumer's life easy as far as managing life insurance policies is concerned. It also implies having all your know your customer documents in one place. Because if you have them in one place, the next policy the individual wants to buy, because he has an account, he doesn't need to be known again.
Right.
Although that was already not required, because when a customer pays, he pays from a bank account. And that means the person already has a bank account. So lots of things we just do.
So certainly inherent advantages of doing that. What are the advantages for the company? Because I haven't seen that push taking place from the companies to say, all right, get your policies digitized. I mean, I recently took a policy, but nobody told me to take that.
Yeah. So see, a company has a cost of about, if you calculate the cost across the entire industry, of about 600 rupees per policy in terms of policy management, policy administration on an annualized basis. So the repositories do this at a cost of about 100 rupees. So there is a 1/6 cost reduction because the repositories specialize at just this. Plus they do it for all insurance companies. So each insurance company does not need to essentially see whatever policies we have. Most companies have got electronic systems in which they keep them. Right. Systems like Life Asia, etc. So the repositories in a way already exist.
Right.
The point is they're not exposed to the consumer. And each company has their own. Now with the e-repositories coming in, with the 5 of them, these 5 repositories can represent all the insurance companies. So all insurance companies can prevent their own cost of storage and keep them all here. So their own cost of storage, retrieval, etc. go down. They can always tap into the repository.
So just clarify this. Now I have, say, a policy by 3 different companies.
Yes.
Right? I can go to this repository, get a single account number, and then transfer all these policies, send them the originals.
Absolutely.
And then they convert that into a digitized
You don't even
form.
need to go and send them the originals. You just need to inform them this is the application number, and there's a form that needs to be filled up for every insurance policy. You fill that form up. You either give it to the appointed person of the e-repository or to your insurance company. Then it's the insurance company's job to make sure that the e-repository gets these details and your policy
So the
becomes
process
electronic.
is different from the shares, right? Because you actually end up sending the originals to the depository in the share.
In this you actually can keep your original policy with yourselves. No problems there. The electronic is a replica of it.
Right. So now, we've been talking about depositories, we've been talking about e-insurance. There's been a huge change in the way people are buying insurance policies online.
Yeah.
Give us an idea about some of the new changes and how should a consumer really adapt to the new environment and take advantage of that.
Let's just look at insurance as a category. It's mostly been, most people, if you ask them why they bought a policy, my agent told me to buy it. Now, the agents will be selling a certain kind of policy. I don't want to go into the good or bad of that. There are 6 things that every consumer needs to protect themselves from. There's death, which is what term insurance policies are for. There's disability, which is what personal accident policies are for. Partial, permanent, temporary, partial. So it can be partial or complete disability. So disability is one piece for which you have personal accident policies. Critical illnesses, cancer, tumor, heart disease, all these dreaded diseases, 35 of them, that one can take a cover from, which is called the critical illness cover. The 4th one is the health insurance, which we've spoken enough about. The 5th one is pensions. Many people in this country are not planning for their pensions, and they are in serious risk of breach at old age. We assume our children are going to take care of us. They may not. And the 5th one is, it's connected in the sense, child cost planning, because we do take care of children when they grow up and costs do come up. These 6 are critical, and we don't need to think about the others till we've sorted these 6. So what electronic insurance is doing, or what internet is doing, is basically the aware people who want to buy these policies are coming and buying them digitally, or buying them through their mobile phones, buying them through their laptops, buying them through their desktops. And these policies, if you look at these particular policies, there's a huge percentage of them. Anywhere between 30% to 90% of these policies are only sold digitally. So there's a great divide coming between what is sold by the offline channel and what is being sold by the online channel.
And is there an inherent cost difference in it? Because, I tried buying term insurance plans, and there seemed to be a difference between online policies and the ones that I was being offered by agents otherwise.
See, there is. The offline
and
cost
why
of,
is that then?
The offline cost of distribution for a bulk of the policies is quite large, because a person has to come to your house, he has to explain the policy to you. Remember, this poor person can only sell about, on average, we have about 30 million, we have about 3 million agents in this country. We only sell about 30 million policies in a year. So 10 policies per agent per year. An active agent sells about 2 to 3 policies in a month. Now to live, he has to earn something. And if he has to earn on those 2-3 policies, he has to make some money, maybe 5,000 rupees, maybe 10,000 rupees. The digital policies are typically being distributed at a cost of roughly about 500-600 rupees. So the cost of distribution is much, much lower. Plus, the level of self-declaration, both from the consumer and from the understanding of what people are buying, is much higher. So lapses come down. So and I don't need to this is not theory any longer. The fact is, 90% of term insurance in this country is sold online.
Well, e-commerce has become a reality of the day.
The fact is, 90% of term insurance is sold online. 99% of traditional endowment policies are sold offline. How much critical illness do we actually sell offline? Just our company, we've done 2,000 policies in this month of just critical illness. Now, who had even heard of critical illness 6 months ago? We've been talking about it on the shows, and then people come in and they buy also. So that's what's happening. Electronic is all about building awareness of these 6 products, and then people coming and buying those products.
And then you've got that advantage of doing that comparative analysis pretty easily and quickly.
That is important. But I would say That is very important, so you can see which policy is good for yourselves. So you've got that big advantage. So obviously you can research. When you buy digitally, you will research. See, a digital customer will not buy what he doesn't want to buy. You don't go and buy the shoe that you did not want to buy. You buy the shoe you wanted to buy. But of course, in the offline world, these are complex products, and sometimes we get pushed a product which we did not want.
What about in terms of, that whole touch and feel thing of saying that, all right, I want my policy in my hand, but you've got all those
systems. You get your policy still in your hand.
You get it, you get that 30-day...
Somebody recently asked me, they got this car insurance policy, and it was a journalist actually, and they wrote to me that, I have got this soft copy, I want a hard copy. Why can't you give me a hard copy? Now the hard copy was going to take a few more days. I said, please take a color printout of the soft copy. It is a hard copy. But that is exactly it. You just take your soft copy, go to a color printer, spend 30 rupees and take a color. If you want, somebody will do it for you. That's fine. But that is all that a soft copy and a hard copy difference is. There's nothing else in a hard copy. So in fact, a soft copy is going to be there forever. The hard copy probably you see how documents get treated. It may or may not be there when you really want it.
E-depositories for insurance. Yashish, is there going to be an incremental increase in, the online insurance policies as a result of insurance depositories now that...
I think the consumer will increasingly buy what is convenient. Convenience is the big point on which, e-commerce is built. And I think e-repositories make it more convenient, because once a person has got one policy or one repository account, he does not need to keep giving his details again and again. It will make it far more easy for him to buy digitally. And of course, it will help. Also from companies, it will really help, because companies don't need to do the KYC again. Remember, KYC costs quite a bit. Collecting these documents, verifying them, etc. Companies, if there are claims, so a company doesn't need to ask a customer or verify how many policies he already has. The repository already has that information. So all this information flow, the information that a customer has provided on one form applies to the next form also. So if he has already declared that, or his policy has been rejected by somebody on certain bases, that information suddenly becomes available. So having information both ways is very powerful for both the companies, because we're underwriting risk, and for the consumers from a convenience standpoint.
Right, all right. Now it's time for questions from our viewers. We've got Shailaja Kapoor, who's written from Bangalore. She says, I have BP for 20 years, for which I take a tablet daily. No complications other than that. This was declared while taking the Mediclaim policy. The policy was issued after paying additional premium, and no exclusions were mentioned in the policy for blood pressure or its associated complications. Now, can this ailment be still cited as a pre-existing ailment while processing any claim for BP-related illnesses?
As long as Shailja has declared this in her application, that these diseases are existed and she's been taking medication for it, and post that it has not been seen as a pre-existing disease, then no, it would not apply. However, if it is seen as a pre-existing disease, if it has been entered as a pre-existing, either she is not informed or it has been written in the policy as a pre-existing disease, then the basic wait clauses of a pre-existing disease, which are between 2 to 4 years, depending on which insurance company's policy she takes, would apply.
Right. We've got Abhishank from Rajasthan. He says, I have a unit-linked plan, which I bought 5 years back. The sum assured for the same is 15 lakhs. I now plan to buy another life cover, as I'm single, but now I'm married and have a 1-month-old daughter. My annual income is 12 lakh rupees. How much cover should I take, and through which route? Also, will it be possible to increase the cover amount in the future when my income grows? What would you suggest? I
think if an income of 12 lakhs, about 1.5 crores of term cover is very important. It would cost roughly about 20,000 rupees. That's critical, especially when there's a young family out there. The other product I would suggest for him is, since your daughter is just born, and as the daughter is going to get older, there will be costs associated to whatever education she wishes to pursue, or her settlement costs, so whether it's into a business or a marriage or whatever. Parents in India do tend to spend a bit in the first 5-10 years of post-college years or college years, post-school years. So you may have a certain corpus in mind today, attach some inflation to it. So just assume that whatever cost you are planning in about 20 years' time, that's going to be about 3 to 4 times higher. Planning for that, take a child plan. I would say definitely take a child plan for the little one. That'll go in very handy. And when those times come when you have to make those expenditures, it will allow you to retain your pension funds, etc., and not end up spending. Most parents, what happens is they end up spending their pension funds in the last 10 years of their service, because that is when the kids are growing up and they haven't planned for kids costs, so the pension funds dry up. And then sometimes the kids do not take care of the parents, and then it's a difficult life after that. So it's a good idea to take a child plan at this stage, especially when you seem to be having some additional funds.
Right, we've got Ketan from Kolkata. He says he asks if a life insurance policy was taken for a parent and the parent dies, will the insurer insist on a sibling to sign for the sum assured to be paid, even though a death certificate was sent?
So see, what you ask is a legal point which sometimes goes outside of the ambit of insurance. A nominee of the nominee gets the insurance funds. However, the nominee still needs to pay them to the legal heirs, because the amount actually belongs to the legal heirs. So as long as the legal heirs are around, they will need to sign up that they do not want these funds for it to be retained by the nominee. Else, but the insurance company will pay the nominee.
Right. So we've got Bala from Kerala, and he says, I'm 29 years old. I want to buy a term plan of rupees 1 crore for 40 to 45 years. Please suggest a good company. And also he talks about riders. He wants to know which riders he can put for that.
So there are about 13 companies that are offering term plans right now. SBI Life, ICICI, HDFC, Reliance, Tata, Kotak, India First, Aegon Religare, Aviva,
lots of companies.
Bharti AXA. I've kind of named 13 already, or I've named 10. So 10 so far. There are a few more. You could take Max Life. I forgot Max Life, which is actually the highest selling one last month. So you could take any of these plans. The prices are very competitive. They are far lower than what the plans used to be 2-3 years ago. There is a lot of innovation that is happening in term plans. So you have policies that pay you in one go, and you have policies that don't pay in one go but pay the family over a period of time, so that the family can support a certain cost base over the next 15 years, 10 years, 20 years, whatever. Aviva and Max Life have these policies. You should look at those. In terms of riders, I think critical illness and disability are strong enough not to be taken as riders, but to be taken as standalone policies, because they are important enough. See, riders have various limitations. Riders have only a certain amount of cost can go into riders. Only 30% of the cost of the policy can go into the riders. However, critical illness and disability are serious enough problems that you have a standalone policy. It will cost roughly about half the cost of a term policy. But I think one should go for that.
Right, Yashish, thanks a lot. That's all the time that we have on this show of Policy Bazaar. But do write to us, write at ask.policybazaar.com. You can tweet us at policybazaar_in, and we'll see you next time. Goodbye.